Introducing Silver Biotics, the preferred colloidal silver supplement of the doc. See silverdoctors.com for details and special promotional offers today, including a specially formulated 30 parts per million, only available from the doc and other healthcare professionals.
This is the Doc with the SD Weekly Metals and Markets. Co-host Eric Dubin is out sick this week, so joining us today we have Tyler, known as Bull Run on Silver Doctors. Good to have you, Tyler.
Thank you for having me on.
All right, so we had a big week in the markets this week. Gold and silver were smashed once again on the FOMC statement on Wednesday, as the Fed stated it will start to taper the $85 billion a month in mortgage-backed securities and bond purchases by the end of this year and be entirely done by mid-2014. So in response, really everything but the dollar was down and down hard. Gold crashed $100 to $12.70 through the previous low back in April of $13.20. Silver crashed just about 10% to $19.50 and through support at 20. Smash in all the markets, as I said, not just gold and silver. Bonds were down hard. The 5-year had its worst week in the history of the last 50 years of recording of Bloomberg data. The rates were up 38% in the 5-year. The 10-year was down hard. So bonds are being sold off. Stocks were down hard, almost 600 points on Thursday. Really everything is being thrown out the window other than the dollar, just on the hint that the Fed might start to taper their funny money printing by the end of this year and be done next year. And as we stated on the show for a while, we expected them to play this mope game, but it may backfire on the Fed with as much of the selling as we've seen. So, Tyler, what's your take on the markets over the past week here on the Fed statement?
Now, I was actually sort of surprised, Doc, because I'm sitting here just taking a lunch break, watching CNBC, and I'm seeing Rick Santelli just blow up on CNBC, and I was like, wow, I still cannot believe they let that guy still have a job on CNBC. But I was not really expecting a market crash going into Thursday and Friday after I saw what the Fed release was. I mean, I was thinking that we may be seeing an uptick because even the national media is starting to talk about QE and the fact that they can't stop printing any monies. Then we had that news come out of China, and I'll let you talk about the China a little bit more, Doc. And I think that was a real game changer.
In a minute here. One thing I wanted to point out that I've noticed here really over the last 12 to 18 months, and it's a point I'd like to point out, is a pattern that's emerged whenever Bernanke speaks publicly or the FOMC meets and makes a statement. As our listeners are likely aware, Eric Sprott first pointed out last summer of early 2012 when we spoke with him at that time that the cartels seemed to have changed their MO from rating the metals on the monthly non-farms payroll reports the first Friday of the month, which they'd done classically for years prior to that. That's the smashes that Andrew Maguire had predicted and let the CFTC know was going to happen prior to. That they had changed their MO from rating the metals on the Friday non-farms payroll report to hitting them whenever the chairman made a public appearance or the FOMC released a statement. This really has continued in 2013, and I've noticed a distinct pattern to how the metals in particular are managed upon the release of the FOMC statements in the subsequent days. And we've seen this pattern on just about every single FOMC statement over the past year or maybe year and a half, with the exceptions of the actual announcements of the new QE programs and the QE3 and QE to Infinity program. And so basically what I've noticed is that either precisely coinciding with the release of the FOMC statement, or in a couple of cases, it actually was a minute or two prior to the release, probably when the Fed leaked the data. But gold and silver consistently see a mini flash crash. It's typically about 20 to 30 cents in silver and about $5 to $10 in gold. Just a straight vertical drop, either right on the release of the FOMC statement or just a minute or two prior to that. And then over the next 20 to 30 minutes, just like we saw Wednesday, both metals retrace most of, if not all, their losses and actually go into the green positive. Shortly thereafter, when Bernanke's press conference begins and the chairman actually begins speaking, that's when they drop the real hammer. And another waterfall decline, typically at least twice as large as the one that occurs on the release of the actual FOMC statement, but really not an absolute slaughter for the metals. So they're consistently down hard, but then slightly recover throughout the afternoon access market section, and they're down for the day, but not by any means a slaughter. But really consistently, the real action has been on the second day after the FOMC statement, and it seems to always start with a major waterfall decline precisely in the overnight London Open, and climaxes on the COMEX Open or shortly thereafter the subsequent day, usually on Thursday, as they usually release the FOMC on Wednesday. And just like we saw this week, in almost every occurrence, the smash is over by the second day after the FOMC statement or on a Friday. This week, too, on Friday, we saw the metals recover to end the week slightly up. This week we saw silver claw its way back above 20 for a close. Gold is trying to get back above 1,300. It's pretty strong capping there, closed just under 1,300. But really, I'm kind of surprised the guys at GATA haven't been pounding on this, as it's become such a strong pattern, and the cartel has followed the playbook on this so classically and repeatedly on every FOMC statement over the past 18 months. So that's kind of what I've been noticing on the FOMC release. Getting back to China, China is really becoming a big issue quickly. On overnight Wednesday into Thursday, their overnight repo rates hit 25%. So we really have China looking like a full-blown liquidity crisis a la Lehman Brothers in 2008. The People's Bank of China had to step in with an emergency $50 billion bailout. So China is right on the precipice, it looks like, and could really instigate the next global leg down. What are your thoughts, Tyler?
I agree with that statement about China. I want to just go in a little bit about what we saw in the sales for SD bullion going into the late part of this last week. Similar to the previous market smash, we were seeing huge demand come across in the physical market. SD bullion phone lines were ringing nonstop Thursday going into Friday. On Friday morning, we were starting to see prices creep back up from the wholesale market. But by the afternoon, we were looking at 2 to 3 week delays from most of the major wholesale suppliers on gold and silver products across the board. Across the retail market, most major retail outlets that we looked at on Friday had price increases of around 50 cents on the majority of the National Mint products. I'd like to take a minute to go back to addressing some of the frustrations I've seen across the physical stackers right now with the market and the lower prices in the paper market. And I want to talk a minute about the 100-to-1 paper to physical ounces that is widely known in the market. And it's easy to understand why this manipulation can be allowed to continue throughout this precious metal smash. It's widely believed that there's 100 paper claims to each 1 physical ounce of actual metal. I would actually go a little bit further and say it's widely accepted that there's 100 paper claims to each 1 physical ounce of actual metal. Now, Doc, you like baseball, so answer me this. If you had 5 limited edition Babe Ruth baseball cards, and you're going to sell them on eBay, but instead you decide to issue 100 eBay auctions for the right to own the Babe Ruth baseball cards you had, I think we all know that 500 eBay auctions for the 1 famous limited edition Babe Ruth baseball card would not bring in nearly the price per card compared to if you'd only offer what actually existed, and that was 5 baseball cards. So now you have U.S. Mint sales. I think we had an article on SD this week. Sales in 2013, I think it's around 24.2 million compared to 17.3 million through June of 2012 for silver ounces. The problem is not the demand for precious metals. The problem is not the limited amount of physical precious metals which exists in the world either. The problem is the system we continue to allow to be in existence.
Yeah, Tyler, there's really no doubt about the paper market still dominating the price action. But I fully expect that to change here in the future over the next 3 to 5 years. It's really the physical market is starting to rear its head. JP Morgan's physical inventories have been down hard. There's been a lot of speculation that this last crash was to try to free up some inventory for JP Morgan. It appears to be coming out of the GLD. In the past week, with the smash, GLD's inventory dropped below 1,000 tons for the first time in quite some time since it was established and went through there. So that's a pretty significant number to have the GLD's inventory below 1,000 tons now. And really with silver back into the teens and gold back with a 12 handle, you're going to start to see a decrease in the mining production. We already had, a month or two back, we had the big collapse at the Kennecott mine over in Utah, which just in one day wiped out 16% of U.S. production of silver, 5 million ounces a year. And again, put that number in perspective versus the U.S. mint sales. We might have 40 million ounces of Silver Eagle sales this year. 40 to 50 is what I'm looking at probably. And so we're at 10 to 12% of that total just wiped out right there in that Kennecott collapse. So the mine production is not going to increase much with the big smash in the price. As well as going into the fall, we do have more of a overall global downturn. The base metal mining will decrease quite a bit as well. So shifting gears or topics a little bit here, I wanted to cover the latest on the NSA wiretapping scandal and the Snowden situation as well here. As the news broke Friday that, really in no surprise to us or probably any of our readers, the U.S. is going to go after Snowden guns blazing. They've charged Snowden with espionage. They're formally requested extradition back to the U.S. They're going to extradite him. They've asked Hong Kong to detain him and then move to extradite him, and they're going to charge him with treason and attempt to execute him. Not too much of a surprise for us. What are your thoughts here, Tyler?
Well, yeah, I agree, Doc. Really is not much of a surprise to anybody who reads SD that this is type of activity is occurring. I think we've known about it for years, but it really pisses me off, and I'm going to kind of get off topic here, but there's a lack of the response from the American people. We're actually we're kind of like letting this happen, and I always expected, as you know, when I was younger, that if something like this happened with the corruption that's occurring in the United States, that we would actually kind of step up, but we just continue to allow this controlled secret police type culture. You know, Doc and I are still working full-time jobs. You know, we have people coming into us every day on Medicaid insurance. This is a topic that I love to talk about outside of SD, but people who are more than capable of finding a job in the workforce, but they instead choose to sit around, you know, do drugs, and they're like breeding kids like dogs so they can make more money off the government, make more money off you and I being the only people that are actually paying the taxes. These people sitting at home, and they're fair checks, and then you have the government that's printing money, and then you have the middle class, and all we do is go to work and pay taxes. So these people come into the office for their kids to get their Flintstone vitamins because, well, they get them free through Medicaid. They cost the taxpayers $150 to $200 for the physician bill. Then they go to the pharmacy, and they cost the taxpayers another $50 for what it costs the pharmacy to fill the prescription, all to get their medication for free. So you have a $250 to $300 healthcare bill, all for their free medication, and all because they did not want to pay $1.79 over the counter for their Flintstone vitamins. That's off the beaten track, but that's my kind of thoughts on this Snowden incident and how we just continue to let this stuff happen. It's, you know, the bailout in 2008, the health care bill that Obama pushed through Congress and in a dirty fashion, and when are we going to step up?
Fashion is interesting. There's been some reports and rumors here. They haven't been too much substantiated, but that the Chief Justice was blackmailed to switch his vote at the last minute. So we'll have to keep an eye on that, whether that story has any legs to it and whether it gets any more exposure. That could really be a game changer for Obama if that actually comes out and is proven. But so getting back to the markets here before we wrap up, really haven't seen too strong of a bounce on Friday in either gold or silver, so really can't be sure yet that the bottom for the latest smash is in. It wouldn't surprise me at all early next week to see the 1200 level come into play, possibly 18 for silver, and that really needs to hold. So it should be an interesting week, but really the sentiment is the most negative I've seen it really across the whole sector in the past 13 years of the bull market. It's possibly worse than it was back right around the beginning of the bull market, around Brown's bottom in 1999, 2000, right around there. So for long-term investors, you always want to buy into a long-term position on extreme weakness when you don't feel comfortable with the position. And I think, as most of our readers attest, making a new acquisition or move into gold or silver right now doesn't feel comfortable because you're scared that it's going to go down further. And really, you have to set aside your emotions, think rationally, and that's when the most money is made. The biggest money is made by purchasing assets when blood is in the streets. It looks to me like the blood is running freely. The miners have just been absolutely decimated, as well as the metals. So for those who have conviction, they understand the fundamentals and are able to set aside their emotions, I personally believe they'll be highly rewarded over the next really 3 to 5 years if they're able to not only sit tight but even add to their positions here into this extreme weakness. Once again, we should have another interesting week in the markets next week. Silver needs to stay back above 20 and put some distance behind that, and gold would need to quickly get up and through 1300 on Monday. So for the Doc and Bull Run, thanks for listening to the SD Weekly Metals and Markets.
SD Bullion.